All right, I just started the recording, everybody. And as Eric mentioned, I am Mike DeGeorge. I am with BKS Partners. Let's see if I can get this to work. I've got over 13 years experience in the industry here. I've been with the same company for all 13 years. So at BKS, my responsibility here is as a partner. So I'm obviously responsible for growing a book of business. We're actively involved in the mentorship program here. So I help train the new sales reps here at the company as well. And my book is specialized in the community association world. So I write policies for hundreds of associations all over the nation. So let's start by just a brief agenda of what we're going to talk about today. I'm going to try to stay strict to our time limit. I imagine we're going to come in under the time limit. So I want this to be as interactive as possible. Please interrupt me with questions. Really, at the end of the day, while we do have an outline here on the PowerPoint, I want to make sure you get out of this what you're looking for. So please don't hesitate to ask questions throughout the entire process and presentation. I encourage interruptions, and I want to make sure that you get out of it what you're looking to get out of it and get your questions answered. So we'll go over different types of insurance, the common provisions on a typical policy. I've got a couple people I'm admitting right now. Okay, we've got 2 more joining right now. Then we'll go over some claims questions, and then we'll spend a little bit of time on the current market trends with the insurance marketplace right now, kind of being in a very difficult, hard to place market, particularly with habitational accounts in older frame buildings. And then as you join, if you can mute your microphone, and of course on mute, so just hop in with any questions you have, that's entirely fine. So a little bit of graphic here. So calling anybody to insure your HOA. So we got a little cartoon graphic here. Sure, we write homeowners insurance. In today's marketplace, which we'll get into quite a bit later, your agent selection process, your broker selection process is more paramount now more than ever. You'll see that we'll get into the marketing reasons on why that's happening. But essentially what's happening is the marketplace has always been a real specialized marketplace. So while there are farmers of the world, countries of the world, and different agents of the world, you really want to find yourself with a broker that knows HOAs, the ins and outs of it, and how to best protect your interests. Because anybody can write a policy covering a building and general liability. The intricacies of covering an HOA is very different than that. So while you're pursuing broker relationships and partners, make sure you're asking them what their experience is like. What states do they write in? How familiar are they with Oregon? What different carriers do they represent? How are they mitigating these different challenges? We'll run into agents who oftentimes won't even have the appropriate coverages. So that kind of brings us into our next slide here. Well, what do we need to write coverage for? First and foremost, property. So that's obviously the most important for HOAs, right? Especially if it's a condo association, we've got to insure the building so that if something happens to the structure, we're able to rebuild it. And again, guys, feel free to jump in if you have questions on these, or you think I might have missed something or anything else. Liability coverage is fairly straightforward. That's going to protect the association. Most of the time, these are, drowning accidents in pools, slips and falls on the premises, things like that. Directors and officers liability. So for the board members on this call, this is by far the most important. And you're going to hear me talking about D&O insurance throughout the call for protection against your decisions as a board member. So it always irks me when the board tries to save $100 or $200 and they point to the directors and officers policy as an avenue to try to make that happen and accomplish those goals. Because what this does is it protects your liability for being a board member. So this should be the most important coverage to you while you're looking through different policies. So common examples for D&O is, claims are challenge to assessments, decisions we're making on the board. So insurance decisions, believe it or not, are included. So you could be held liable for making a bad insurance decision on the board. Challenges for, not recording the proper minutes at meetings, not adhering to the bylaws of the association. These are all common examples of things that the directors and officers policy would pick up. So the typical limit on this policy is $1 million. And we always try to increase that by the means of an umbrella. So if we add an umbrella policy, so I jump down to the bottom here, that policy is going to go over the directors and officers limit. So we'll write a $5 million umbrella is very common. So with the $1 million D&O limit, that gives us $6 million in total limits for that type of event. Does anybody know what fidelity coverage is that's on the call into the board members? Anybody want to hop in? I don't think so. Nobody's brave yet. That's okay. We'll get there. So fidelity is going to cover the association funds. Okay. So Aperion, well, a great property manager, if they steal some of your funds, that's where this is coming from. Or a board member, if they steal some of the reserve funds and spend it on whatever, a brand new car for them. That's the coverage that's going to come in and reimburse the board for those theft of funds. Cyber and crime coverage they're kind of hand in hand nowadays. Cyber is going to protect you so that if you guys have people paying their association dues online and say their social security number, address, name gets stolen on the internet, and you've got to send out notices and things like that, cyber would cover that. Crime coverage is arm in arm with fidelity as well. So it's meant to cover your association funds. One of the coverages here, which is becoming more and more prevalent, is theft of electronically transferred funds through phishing campaigns and things like that. So we want to make sure we have a cyber policy and a crime policy that contemplates both those exposures. And in fact, in Oregon, there's legislation which requires that. And we still run into a number of crime policies where other agents haven't caught up to that new statute just yet. Workers' compensation is a big one. Oftentimes I hear from board members, we don't have any employees. Why are we protecting anybody from getting injured? And while that's true to a certain degree, what we're trying to protect is if we don't have any employees, that any subcontractors that are working on your premises are adequately insured. Now, Aperion has checks and balances in place to help prevent this. So they're going out and they're asking all the vendors for certificates of insurance. They're getting waivers of liability, making sure that these folks that are on site have their own policies in place and have their own work comp. So what we're writing is called an if any payroll policy. And essentially what that does is it covers you in the event that one of the subcontractors forgot to pay his work comp bill and now has a lapse in coverage. Or he told you he's got work comp coverage, but the certificate has since expired. And so now he's an uninsured sub and he is on the roof fixing some roofing up there and slips and falls off the roof. Well, if there's a $300,000, $400,000, $500,000 claim and his company doesn't have workers' compensation, then the board ultimately would be responsible for workers' compensation in that event. And so the if any policy is a really cheap and inexpensive way to cover the board for that type of exposure. They're typically around $600 a year. Any questions on that so far?
I don't have a question, Mike, but I was wondering if you or if Marilyn can mute herself. I think it's giving feedback on the video.
Yep, I just muted her.
Okay, thank you.
Sorry, Marilyn.
She can totally jump on if she has a question. I think it's just creating an echo a little bit.
No worries. Is this a little bit better?
Yes, thank you.
No problem. All right, so that brings us down to the umbrella. So we're going to get into the state of the marketplace towards the end, but nuclear verdicts are up exponentially. So in 2005, your typical slip and fall claim, say it sold for $75,000. It's up nearly 10 times that nowadays, where those minor claims, which once were settled and litigated and kind of went away, those are now settling for $500,000, $600,000. So it is important to protect the association by the means of purchasing an umbrella policy. And what that does is it goes over all the underlying liability policies. So your general liability policy is going to have a $1 million limit. Your directors and officers liability is going to be 1 million as well. And your workers' comp is going to be either 500,000 or 1 million. So by purchasing a $5 million umbrella, we've now increased the liability for all those policies by 5 million. So you now have $6 million in coverage for a general liability event or a D&O event. That's especially important nowadays, particularly if it's a resort style type condo, or there's short-term rentals, or there's pools on premises. or icy winters, obviously with slips and falls and things like that. It protects you against that one big shock claim, which may be a couple $1 million. So that's a brief overview. There's obviously a lot more in each policy. That's a brief overview of what we're covering. So here's a little cartoon graphic on why do we need D&O insurance? I'm not a doctor. I'm not an HOA expert. So this goes back to our important point of when you guys are going through these policies, particularly the audience we have on this call as board members, I really want to stress the importance of making sure that the D&O policy is in place and that it's a broad policy. And we'll get into a little bit more in depth in that on the next couple slides here. So common provisions, what is and is not included. I'm going to open this up for discussion as well if you guys have any individual questions, but here are some of the topics that come up often when I'm talking with board members. Coverable event versus wear and tear. This is by far the most common thing that I run into with boards. There are a lot of people that think, hey, we have insurance, just file it under insurance. It's going to be covered and we're going to move on. And insurance is no different than any other contract. There has to be a coverable event. Okay? I always joke that insurance policies 10,000 years ago probably said, if something happened to your hut, we'll rebuild your hut. And over the years, the average insurance policy now is 350 pages or so. Well, we'll cover your building unless this happens. And of course, unless this happens and this. And so there's all different sorts of exclusions. One of the most common is wear and tear. So for example, if you're getting water, if you've neglected your siding maintenance for 20, 30 years, and you're getting water and seepage in through the siding and the siding's starting to buckle and burst and things like that. Well, if it happens over time, over a 5, 10, 15-year process, they're not going to just come in and the insurance company's not going to write you a check to fix the siding. That is something that we've got to do on our own as an association and standard maintenance. Now, if a windstorm comes through and rips off all the siding, that's of course a wind coverable event and the insurance company will come in and pay it. But if you guys have specific examples where you maybe thought there was coverage in an instant and now there isn't, or it was declined, let me know. I'm happy to go more in depth in that as well. Hang on, I'm going to admit Beth here. So that's one of the more common things that we run into with boards. Well, it's not that old and it's got to be a singular instance, an event that is covered in order for us to provide coverage. Wind hail is not as big of a deal in Oregon, but I still included it here because it's obviously big across the nation. Wind hail coverage is being excluded on a lot of policies, particularly through Tornado Alley and the coastal regions with high cat zones. So while it seems very basic, you're going to want to double check and make sure that that is on the policy because it could very easily be excluded. Or it could have a very high deductible, which brings us to wildfire and brush deductibles. So what we're seeing here is with analytics changing, Oregon is remapping and rezoning their aged wildfire and brush deductibles, and carriers are now catching on. So carriers that used to feel mightily comfortable writing in an area that wasn't a brush area, well, now they have this new model that says it might be higher if there's a different wind current and things like that. So keep an eye out for the brush deductibles. There's two types of deductibles, an AOP deductible, which is all other peril. So that essentially means anything that happens on your policy is under that deductible. And then there can be also a wildfire brush deductible, which is only applicable in the event of the wildfire. Okay, but those can be very, very significant depending on your area. We run into policies where they have $1 million deductible, or sometimes it's 10% of the overall insurable value of the property. So it's something to keep an eye on so you're not blindsided in the event of a loss. And we want to be cognizant with the reserves as well to make sure we can afford some of these deductibles that are increasing with time. So back to directors and officers coverage, included versus monoline policies. So we'll run into a lot of carriers like the Countries and State Farms of the world, and the Farmers and Country Financials, and even the Travelers and Hartfords of the world, where they offer two separate policies. One which you purchase on a standalone basis, which offers more coverage and is a little bit more expensive, and one that's just included in their package with the general liability and property coverages. Typically, those included forms have much less coverage than a standalone monoline policy. It almost always is the case. So things like, insurance decisions would be excluded in an included policy. Non-monetary damages, it's just not as broad of a form. So when you're going through and looking at the agent proposals, I challenge you to ask them, why didn't you quote a monoline policy with more coverage? And can we go through some of these coverages? Or ask your property manager or myself to take a look at that for you. So delving into that with the cybercrime and fidelity, again, that's a very common mistake that we find with with agents that aren't as familiar with the Oregon statute, that, yeah, you do need fidelity coverage, but it also has to include cybercrime and electronic transfer fraud. Okay, those are litigated now in Oregon. So if we don't have those coverages, you could be sued as a board member for not procuring the adequate type of insurance. And then our largest kind of nuance with policies comes between the unit owner's personal lines policy and then the condominium policy. Now, the condominium policy is meant to rebuild the building, okay, but on a walls out basis. So what that means is, in the event of a total loss, our policy is going to rebuild your entire structure, all the rooms, everything, including drywall, the electronics, piping, all the common areas, everything up to and including the drywall and first coat of primer. Now, the caveat there is, depending if it's an HOA, the bylaws can be a little bit different, that you have the decks and bylaws, and it can include interior finishes and things like that. But typically, a regular condo policy is meant to just cover walls out, which means the unit owner is responsible for everything within their unit. That includes paint, hardwood floors, cabinetry, plumbing fixtures, all the furniture. That's got to be insured on their own. So one of the most common claims examples that we see is a burst, like a leak or a burst pipe on the top floor will drain down 2 or 3 floors and cause all sorts of drywall damage. And it also ruins some tile floor, some hardwood floor, some furniture within the unit. Well, our policy is only going to contemplate fixing up the drywall and first coat of primer. So it's important that the unit owners have their own policy in place to protect those assets within their individual unit. Are there any questions on that? Because I know that a lot of the times on these calls, I get quite a bit of questions there. Okay, nothing there. So claims. What do we do? Let me start this out with a question. What do we do? What's the very first thing we do when something happens in the building, we got to file a claim? How do you guys typically handle that? The way we'd like to, go ahead.
They call the manager, Mike.
Yeah, exactly. Good.
I'm glad you're going to cover this, because I have a claim currently that I just opened today at a condominium association. And I think often there is some confusion on, do you call in someone to begin investigating and repair? Do you call the insurance company first?
Yep.
Do you wait for the adjuster? What if it's an active situation that needs to be addressed, right away, like water,
Yep.
right? Like a big leak is happening. So educate us.
So we'll go over what I'd like to see as an agent, my ideal workflow of a claim. You're exactly right. Reach out to your property manager, make him or her aware of the issue, and report as many details as possible. Okay. From there, the property manager, I'd like for them to contact me or the agent as quickly as possible to discuss the coverage, maybe any coverage issue that might happen, get the claim actually filed, and have an adjuster assigned to it. Okay, and then obviously we want to mitigate damages immediately to protect future losses from occurring as a result of this loss. And then the agent should be communicative throughout the entire process of the claim and making sure it's handled properly. So some of the biggest issues that I see is when a board member or an insured or a tenant calls the insurance carrier directly and files a claim. Okay, and the thought process there is good. It's, hey, I don't want to bother anybody. Let's get it into the insurance company and let's get it fixed. what that person is unaware of is there are a lot of provisions in insurance policy which may or may not come into play. The most common example of that is in the event of a common water backup claim. So, I run into this all the time where one of my clients will call the carrier directly and say, our basement flooded, so we need you to come out and get it fixed, and we want money to get it fixed. The insurance carrier almost always will deny the coverage claim then because of flood. They'll come back and say, well, you don't have any flood coverage, and just close it out and be done with it. Where in reality, what you need to be saying to the insurance carrier is, hey, a sewer backed up from the basement and we got water in through the well, right? Through the sump pump, and there's water all over. Well, that's a water backup claim, and that is contemplated on the policy, and that is covered. So that's a common misstep by not taking this type of approach where you reach out to your property manager, he or she reaches out to the agent, they discuss the claim and put it in a position where maybe they can find a gray area to find coverage, or at least then they'll know, hey, this is covered and here's why, and it helps make the process go a lot quicker and smoother with the carriers. Okay, so it really is. I mean, you're hiring a property manager, you're hiring an agent. It's important to utilize those resources and lean on them, particularly in these cases. Now, point number 3 is particularly important. I get a lot of pushback from boards like, well, we don't want to do anything until we know this is covered, until we get money coming in, because we don't want to be out of pocket for the damages right away. Well, there is a provision in the policy which states that if you don't mitigate any of the property and damages, and it causes future damage because you refuse to mitigate it, maybe you let water sit on site for 3 months and now you have mold. Well, those resulting damages would be excluded from the claim. So the carrier wants you to go ahead and mitigate it as quickly as possible. Get that, get the company out to start sucking up the water and drying out the walls. That is something that needs to be done right away. And of course, you'll be compensated for that as part of the claim. Any questions from the property managers on this process or the board members? This is typically how it's handled, but we don't love when people go sort of rogue and start filing their own claims and things like that. Because there are cases where, maybe it's a $6,000 worth of damage into a $5,000 deductible. And now you're talking about, well, what about renewal strategy? Are we better off keeping the claim off the policy altogether and paying out of pocket so that our rates don't go up each year at renewal? So there's a lot that can kind of go into it where we can educate you and make more informed decisions on your behalf.
Mike, this is Eric. I have a question in terms of filing the claim and the information that you're providing up front. And I know we have a number of board members of Aperion clients on the call today. So when Aperion steps in and manages an insurance claim, so, files the claim, coordinates with the mitigation and repair company, communicates with the owners, all those pieces are all actually not part of our contracts with our clients. They're an additional expense because they often immediately take a large amount of time and resources from a number of people on our staff, and they're completely unpredictable as to how much amount of work that's going to be and how long it's going to take. So we do charge extra for that work. So I know I've encountered in the past resistance or confusion from carriers on whether or not that work can be covered under these kinds of claims. So I don't know if you have experience in that or any comments on, is there a way to, or a strategy to try and get a carrier to cover the management of that claim on behalf of the association by their manager?
Yep, and that's very, very common. It comes up all the time. The answer to your question is there is no blanket answer. Each carrier has a different process on that, and it's more of a case-by-case basis throughout that process. I will tell you from an insurance agency standpoint, the claims that are handled with the property manager as the contact tend to move a lot quicker because they have preferred vendors, and so they tend to move quicker and end up being cheaper. So that is what we end up telling the insurance carrier and trying to push to get that cost recouped as part of the claim. But sometimes they say yes, sometimes they say no. It honestly just depends on the carrier. And if the extra services are being billed by a parent or maybe or a sister company. A lot of the times property managers will have different companies that they're sending the bills through, like a contract, like a general contracting company and things like that. So there's a lot of intricacies on that, and it is something that comes up quite a bit. So I can tell you that as an agency, we always push because we see a lot of value in that. And so we always push to get that covered as part of the plan.
Thanks, Mike.
Yep. All right, no more questions on claims? All right, we'll keep plugging along. All right, so current market trends. This is kind of a toughie. So we're in what's called a hard market. It's been hard now for about 3 years, and it's getting worse and continues to get worse. Property rates are going up across the board. CAT scores are going up like crazy. The amount of billion-dollar weather events that we have throughout 2005 to 2015, we could reasonably expect about 10 to 12 billion-dollar weather events. Since 2015, we're seeing 15 to 25 billion-dollar weather events. So it's up quite a bit. And that is causing carriers to operate with a bad loss ratio. So we're 3 years in a row now where carriers' loss ratios exceed 100%. What that means is they're not making money. And when they're not making money, they've got to raise rates. Right? So there are a lot that goes into what's going on. Analytics, particularly in Oregon, applicable to brush scores, analytics and modeling has taken a step that, I mean, you see in baseball, and they're using analytics everywhere. But these models are getting very sophisticated, especially now with AI data, artificial intelligence kind of running these models as well. So they're able to predict with much more certainty when there's going to be a wind hail storm, when there's going to be a hurricane. Brush scores, the data now, they're predicting wind currents, so that if there's a wildfire in California, well, what are the odds of an ember from there traveling all the way to Oregon and lighting up a fire in Oregon? So all of these things are creating havoc in the marketplace, and these models are making it so that carriers that used to feel comfortable riding in a certain area in Oregon now can't, because the brush score is too high and the reinsurer won't allow them. So that's kind of the models, and the data are running a lot of that on that side, which causes a reduced capacity and change in appetite for the carrier. So carriers that used to write a lot of 1970s frame are now saying, well, our data says that's not a profitable line of business. And so they're just stopping altogether writing older frame business, where in the past they've written it for many, many years. We touched on the umbrella a little bit earlier regarding nuclear verdicts. This is something that isn't changing. Juries keep awarding insane amounts of money to plaintiffs for injuries that, slips and falls and things like that. And it's continued to increase tenfold over the last 7 to 10 years. Okay, so as a result, the umbrella marketplace has shrunk. There used to be about 10 different, called MGAs, so 10 different programs that wrote only umbrellas in the condo and HOA space, and they wrote them for very cheap and for very high limits. 5 of those markets are now gone altogether, so we're down to about 5. So with those nuclear verdicts, carriers are saying, well, we can't even figure out how to price this, so we're just exiting altogether. And as carriers exit the marketplace, that reduces competition, thus increasing the rates. Now, that being said, because of the nuclear verdicts, it is a very important policy to put in place. So inflation, I'm sure everybody here is sick of hearing about inflation. The Fed seem to raise their rates every day to combat it. And what's happening is with the supply chain issues still getting better now out of COVID quite a bit, but there's still a lot of supply chain issues out there. And it's running into higher ITVs, and ITVs are insurable value of our building. So buildings, you'll notice this on renewal, so keep an eye out for it. If your building used to be insured for $10 million, okay, what that means is in the event of a total loss, they estimate that it would be $10 million to replace it. Now they're saying at renewal, well, we need it to be $14 million. So as opposed to, in addition to raising your rates to begin with, the carriers are making you high buyer limits. Why the carriers making you high buyer limits? 2 parts: because of inflation, things cost more now than they did a year ago, and reinsurance. Okay? And what reinsurance is, insurance carriers buy insurance on their own policies. So they may write a $10 million policy and then go out and buy $9 million worth of reinsurance on it from a Lloyd's of London market, so that in the event of a total loss, they're only responsible for the first million. Well, reinsurance carriers, if you've looked at the news back in January, rates were up about 50%. So what that means is the cost for carriers on their insurance is going up. So they pass that down to the clients. So that causes a raise in rates. And the next big chain of reinsurance renewals are coming up here on June 1st. And we're already being told that rates are up another 30% just based off of the January 1st increase. So that's two very large increases in a short period of time that carriers are trying to navigate. So with those increase in costs also comes a reduced appetite and capacity. So reinsurers are saying, we won't even let you guys write. If you want to buy from us, we're not even going to let you write in these high cat areas that are prone to hurricanes. We're not even going to let you write older frame buildings, which we know are going to need new roofs. So carriers are not only having to raise rates, they're having to limit their competition and their appetite. Okay, and thereby eliminating competition, less carriers that are willing to write it, less supply, higher costs. So which leads me to my very last, I'm sorry, type of point, budgeting for renewals. We're finding the average renewal increase on a totally clean account that everybody wants to write is anywhere between 10 and 15%. Okay, so for budgeting purposes, I would budget 15 to 20% if you're in a desirable area and you had not had really any claims issues and things like that. Now, that being said, every account is unique. So if we have a position where there's been a lot of claims, or the appetite is reduced or the brush score has changed, I mean, we've seen renewals that have gone up substantially, doubled and tripled in premium. So it's really important. We as agents, our job is to communicate that to the property manager, let you know what to expect so that when we are putting together our budget, we know what to budget for accurately. And somebody isn't blindsided by a renewal that's 3 or 4 times the amount that they're used to paying. So that's our job as agents. And that's why we're doing these types of seminars. And that's why Aperian's running these types of seminars. We really want to communicate and educate our board members so that they're not blindsided by the marketplace. We can't control the marketplace. We can continuously keep you below what the average marketplace is. And we're really good at that, but we can't control some of these outside issues with billion-dollar weather events, reinsurers, and things like that. So hopefully we've done a good enough job on that, and we can open it up to questions on any specific questions or anything else you guys might have for us.
Mike, I have a question.
Go ahead.
So, yeah, my name's George. I've got a condo in Frisco, Colorado as well. And I don't know if you're familiar with the Colorado situation, but we're not in Frisco. We're not even able to find any insurance carriers who are willing to insure in Colorado anymore. It's a total crisis situation there. How close are we? I mean, your discussion here in Oregon seemed bleak, but it seems really rosy compared to Colorado.
Yeah.
Can you say a little bit more about are we headed that way in Oregon potentially in the future, or is there something unique about Colorado that's really hitting the fan, let's say?
Yep. So I'll go over kind of the toughest markets to write in, and then I'll elaborate a little bit more on Oregon to get back to your second point there. The toughest marketplace to write in right now is Florida, hands down. With Ian and Nicole coming through, it is near impossible to find any insurance capacity to cover hurricanes right now. Texas is second with all the bad wind, hailstorms that go through there. Colorado and California are kind of tied for third place on that. In Colorado, if you're familiar with it, wind hail deductibles became real popular in Colorado about a decade ago. The rest of the states kind of slowly are catching up, with now the Midwest starting to apply 2%, but In Colorado, they started with a 2% wind hail deductible, and you'll find policies out there now that have a 10% wind hail deductible, or George, as you mentioned, carriers that just won't even write. We navigate that through proprietary programs that our agency owns and put in place specifically for high cat areas. But Oregon, to answer your question, Oregon has not historically had to deal with any wind hail. That's not really been a big deal. I don't expect that to change. The challenging and the question with Oregon is these new models that are predicting brush scores. So what we're seeing is the zones have been outdated and the information is really old. So what is considered a low risk zone still, the model is saying is now a high risk zone. And so they're in the process of remapping all that and have remapped a lot of it. And so we've got to really wait and see how the state's maps interfere with the modeling of the insurance companies, because those are two different things. And so the companies aren't going to care. They're going to do whatever their model says. But we need a state map to help support a low risk zone to help pursue that with a different carrier. So to answer your question with Oregon, I don't think it's that bleak. There are going to be areas where there's going to be surprises where it's like, well, wait, we've lived here, for 50 years and there's never been a wildfire. Why are our rates going up 300%? That's going to be something that we're going to see on a case by case basis, but I don't think it's going to be as blanket brushed as the wind hail and as in Colorado and Florida and Texas.
I hope you're right.
I hope so. Any other questions? All right, well, if there's no more questions, that wraps up my presentation. I thank you guys for making time for me here. I guess I'll pass it back to Eric for any closing statement he wants to make, or we can stop recording, Eric, or let me know what you want me to do here.
Thank you, Mike. Yeah, we can go ahead and stop recording. And just a big thank you to Mike for taking time out of his day and his lunch hour. Well, I guess you're in a different time zone, Mike. You might already eaten. And everybody for taking the time today. This is critical and important information for every association and every board member. And I think that about wraps it. Jessica, anything else?
No, I think that was awesome. Thank you so much, Mike.
No problem. I'm going to stop the recording right now. Thank you all for your time.
Thank
Thanks, Mike.
you.
Great, thank you.